Let's look at what happened in the stock market yesterday. Wall Street stocks tumbled on Thursday as a round of upbeat economic data bolstered expectations that the Federal Reserve will continue to aggressively lift borrowing costs to fight inflation. The gloom was deepened further by weak earnings news, including from chipmaker Micron Technology, which announced plans to axe 10% of its workforce amid weaker demand, while used car dealer CarMax said it was halting buybacks and cutting costs after a 4/5 plunge in third quarter net profit. The S&P 500 closed 1.4% lower, having fallen almost 3% earlier. The tech-heavy Nasdaq Composite Index slid 2.2%. The S&P 500 is off a fifth this year, leaving Wall Street's blue chip benchmark on track for its worst year since the 2008 financial crisis, according to Refinitiv data. Thinner year-end trading conditions were also a factor behind the hefty falls as the holidays approached. No one wants to put on exposure at this point. Everyone is just trying to finish this year, said Jimmy Tierney, Chief Investment Officer for U.S. Growth at fund manager Alliance Bernstein. He added, "The big issue in 2023 is going to be that now the Fed has done its thing. What does that mean for earnings growth?" Micron's news sent a raft of semiconductor-related stocks lower, including NVIDIA, down 7%. Elsewhere, Tesla was another big faller, off 8.9%, following the news that the carmaker had increased the discount it was offering on some models. That raised fears it too was facing weakening demand. Before the market opened, U.S. third quarter gross domestic product growth was unexpectedly revised to a 3.2% annualized rate from 2.9% in November. Weekly initial jobless claims numbers were also lower than expected at 216,000, below the 222,000 forecast by economists. The upward revision confirmed the Fed's assertion that the real economy is on strong enough footing to endure restrictive monetary policy for an extended period of time, said Ian Langren, head of U.S. rates strategy at BMO Capital Markets. Wall Street's declines early in the session hit European stocks, which had earlier wavered between small losses and gains. The Stoxx Europe 600 fell 1%, while the UK's FTSE 100 gave up earlier rises to trade 0.4% lower. Earlier, the MSCI Asia Pacific rose 0.8%, recovering some poise after the Bank of Japan's shock decision on Tuesday to relax its policy of pinning bond yields near zero. The signs of U.S. economic strength also dented appetite for interest rate-sensitive short-term government debt. The two-year Treasury yield rose slightly to 4.28%. Longer-term government debt continued to be steady after being shaken by the BOJ's surprise move. The 10-year U.S. Treasury yield held roughly steady at 3.69%, while yields at the Eurozone and the UK climbed slightly. In currency markets, the pound fell following data showing the UK economy contracted by a larger than expected 0.3% in the third quarter from the previous 3 months period. Sterling traded 0.4% lower against the dollar at $1.203. The figures suggested the anticipated downturn in the UK economy could arrive sooner than expected, said Recap Dec economist Ali Henderson. The question now is whether the economy manages to eke out growth in the fourth quarter and avoid a recession at the end of the year. She said. That's the end of this article, and my immediate comment is that UK is already in recession, not avoid a recession. The fourth quarter cannot be good. And in general, the financial market will not be doing well because the current economy is still very strong. So the interest rate hike will continue, and a recession will come eventually. So all these things will say the market will be tough. That's the end for this reading.